coming into this year, the economy had a fair amount of momentum, which is good, but I think we're now losing that momentum in part because fiscal policy, broadly defined, is turned from essentially a tailwind to a headwind.
You sound a little more cautiously optimistic, shall we say, now than maybe last year when I interviewed you. What changed in the last 12 months? Sam Burns returns to the show. He is a chief market strategist at Mill Street Research. He was previously on the show several times in the past. We can check out our prior interviews, links down below. And Sam has been very accurate in calling for the rise of equity markets over the course of 2024 and into 2025. He's also been correct in predicting monetary policy. So I'm very excited to bring him back on to give us his outlook for the remainder of 2025. Welcome back, Sam. Good to see you.
Hi, David. Thanks for having me on.
We're going to be going over your global equities outlook as well as your outlook for Fed policy, and maybe give us your outlook for policy. I know it's a very uncertain regime right now, but people are asking for clarity in times of unclarity, and we'll get your outlook on inflation and global monetary macroeconomic growth as well. Let's start with this particular report that you've published last week. This is your current market outlook. You wrote that the current model that your equities research uses, the current model reading of 66% on the 0 to 100% scale, was unchanged from the prior week. The model has made its fastest round trip from bearish back to bullish in its 33-year history amid continued macro policy uncertainty. So I'm guessing it was underweight equities before in early August, and now it's back to overweight equities. Why the very sudden 180 change, Sam?
Yeah, no, it's been really dramatic to see the model move like that. And of course, it's reflecting in a lot of ways what the market itself has done. And one of the studies that I showed recently was that this was, I think, the fastest move in the S&P 500 from an all-time high to a decline of at least 18% to back to a new all-time high in at least since 1960 in the data I looked at. So this has been a remarkably fast decline and then reversal back up again relative to all previous kind of declines of this magnitude. So that's kind of what the model there is capturing, because some of the components of it do try to stay in harmony with the overall market trend and momentum and risk appetite in particular. And that's really been the factor that's changed, as people went from very bearish to very bullish within a matter of almost weeks, really, which is very unusual. So we respect the trend and try to stay in line with it, but it's been a lot more volatility in that than there has been historically.
Okay. Any particular event that swapped it back into bullish territory?
I mean, the sell-off in April was mostly driven by the initial set of tariffs that Trump announced in early April. The Liberation Day tariffs that set off a big sell-off, and then at least partly in response to the market, Trump kind of backtracked and reduced some of them. And then there's been a lot of pauses and other kind of changes to the policy, and so the market has decided that the policy impact of tariffs and things like that will be less than they originally expected, and therefore that they could kind of go back to buying stocks again. That plus the fact that a lot of the big technology and AI related companies that everyone's familiar with have continued to spend money, continued to kind of build out that kind of big tech, and that's been showing up in earnings recently. So that's kind of been the driver, is that earnings have held up better than expected, and the policy is not as bad as it initially was thought to be, even though it's still actually quite bad.
Not as bad as it was initially thought to be, but it's still quite bad. So people thought it was going to be worse. But I mean, is it bad or is it okay? I mean, how would you characterize it?
I would characterize U.S. macro policy, which includes tariffs and other trade barriers, immigration, healthcare, everything else, as bad. I think it's a significant headwind to U.S. growth. I think the growth rate of the U.S. economy will be much slower than it would have been otherwise. But I think that's going to take a while to show up in the economic data and in corporate earnings. And I think the market is kind of ignoring a lot of that for right now and focusing mostly on, tech and AI spending, which is still quite strong for sure, but kind of ignoring a lot of the rest of this because they assume, I think the market assumes that the tariffs and things will fade or go away soon, and I suspect they probably won't. I think it's going to be causing a lot of problems, but it's going to take a while to show up before people really realize it.
So if an investor were to have like a 3 to 5 year time horizon, should he position himself for this imminent economic slowdown, or should he be riding this AI hype wave?
Yeah, I think right now, kind of what I've been telling clients is to kind of take a barbell strategy where you keep some exposure to kind of the riskier side of the market in technology and communication services sectors, particularly the large cap end of that, more so than the small caps. And then kind of hedge if you want to with, say, like utilities or real estate kind of holdings, which would benefit if interest rates come down. So my guess is that if the economy does slow down significantly, the Federal Reserve will at some point cut rates, and that will benefit the interest rate sensitive sectors, whereas the technology sectors might come under some pressure but have still some of that secular growth behind them. The areas I would avoid would be kind of the energy and commodity sectors, commodities and consumer sectors, which are most impacted by tariffs and trade and are really feeling more of the brunt of that right now.
Okay, I'm going to come back to Fed policy in just a minute. But let's talk about where to find yield. In the past, not too long ago, global real yields were pretty low. And in fact, right after COVID, it was negative. Right now, it's positive, but inflation still remains an elevated risk, especially after the latest reading, which was up from the previous month. So, where to find yield is the question. Equities, or can we park our cash now in fixed income?
Yeah, I mean, right now I would say, having some fixed income is probably a good idea. And I think TIPS yields, the inflation protected treasury bonds, still look pretty good. They've still got pretty high real yields on them. And if there's a chance of a meaningful slowdown in the economy, I think that would going to look pretty good, maybe in a year or two, to hold some of those TIPS yields, which protects you from inflation and gives you a reasonably good 2%, something like that, real yield on top of inflation. So I think that looks pretty good relative to what what the valuations for stock prices look like right now. So like I say, there's some areas like utilities and real estate within the equity market that have some decent yields on them and would offer some some income for equity-based investors. But I think some fixed income makes sense here. But I wouldn't necessarily reach for high yield, for lower credit rating type companies or investments. I would stick to sort of higher grade things that have less default risk.
You've heard me talk a lot recently about rising gold prices and how important it is to be building your savings in hard assets like gold and silver. But what if I told you that you could do a lot more than just holding gold? What if you could also earn income from it paid in gold? That's exactly what today's sponsor, Monetary Metals, is doing. They're revolutionizing how people invest in gold and silver. Instead of paying to store your metal or watching it sit idle, now you can get paid to own it. Right now, in their marketplace, you can earn up to 4% interest on gold paid in gold. That means your holdings grow in actual ounces, not dollars, on top of any price appreciation. Interest is paid monthly in physical gold, which you can redeem and take delivery of. Thousands of investors are already earning real interest in physical gold and silver through Monetary Metals every month. It's time you did as well. Go to monetary-metals.com/Lin, link down below, or scan the QR code here to learn more and get started.
Let's take a look at your asset allocation priorities. How would you weight equities versus fixed income versus alternatives or cash?
So right now I'm telling clients to keep sort of a neutral exposure to equities. My model, as you mentioned earlier, is bullish right now. And so I certainly want to kind of respect that kind of intermediate term trend. But my valuation indicators are fairly cautious. And from what I can see in some of the sentiment indicators in the market, showing a lot of kind of speculative enthusiasm, that gives me a little more caution about kind of putting a lot of new money to work in equities right here. So I would keep kind of a 60-40, balanced exposure between equities and bonds right now. And then wait to see if equities start to lose some of this momentum, then you might have to shift a little bit more towards fixed income. So I don't want to fight the trend right now too much, but I'm concerned about valuations, and I'm concerned about some of the speculative enthusiasm that I'm seeing. So looking out, say, 6 to 12 months, I'm not quite as bullish as maybe that model reading would suggest.
Well, let's talk about some tailwinds now. The risks to the upside. You wrote here that the gains in equity indices have been led by riskier stocks recently, and this has helped push our index of returns to the highest volatility stocks globally up. While this is normally a good sign, the fact that risk appetite has been so volatile and reached extreme levels is somewhat concerning. To what degree is it concerning? I mean, should we be taking some profits off the table, or are you just kind of eyeing it for now?
Mostly eyeing it for now, but like I say, sort of a more typical, kind of bull market behavior would have been, a sell-off and then a consolidation period, and then more of a gradual return of risk appetite that builds up over, a number of months maybe. What we saw here was very much of a, kind of a V bottom and a really dramatic sudden surge in risk appetite to very high levels right now. So to me, that's probably not as sustainable a move. It's very hard to predict the timing of these things. Sentiment is notoriously difficult to use as a precise timing tool. People can kind of get very optimistic and stay there for a while, but it does tell me that there's a lot of that kind of enthusiasm already in the market, and therefore it's going to be harder to produce kind of, I guess, what I would think of as upside surprises from here. I think there's more likely to be, downside surprises if we let go of the next 6 months. So I'm watching it for now. Like I say, it's sort of a concern in the sense that it's not following some of the typical market behavior that you would expect to see at this phase of the cycle, and therefore it's a sort of an intermediate term to longer term concern, but not something to do right this minute.
So if we were to assign probabilities to these scenarios, base case being, let's say, S&P being around 6,300 to 6,500 points, which is range bound to slightly up by the end of the year, or let's say S&P towards 7,000 points by the end of the year, or S&P back down towards 5,500 points towards the end of the year. Which of these three scenarios is most likely?
I would probably say the sort of, consolidation is probably the most likely of those three scenarios. Big upside is probably the least likely, whereas some a pullback of some kind, between now and the end of the year is probably this, sort of second most likely, I guess. Like I say, I think there's the potential for some disappointment later in the year in terms of earnings and economic data, but there's the chance that the Fed can cut rates as in response to that, and so you might get more choppy action and consolidation between here and the end of the year.
You sound a little more cautiously optimistic, shall we say, now than maybe last year when I interviewed you. What changed in the last 12 months?
Yeah, I'm definitely not as sort of bullish as I had been, in 2023 and 2024. And a lot of that, kind of falls back to partly where we are in the cycle. We had a bear market in 2022 and in sort of a slowdown in economic growth. It was not a recession, but it kind of got people worried about it. And then you had 2 years where people kind of unwound that kind of bearish economic view. And you had a lot of very supportive fiscal policy in particular coming through. So a lot of those programs that you saw from the CHIPS Act and Inflation Reduction Act and things like that were a big help to the U.S. economy and helped earnings, growth and things like that. So that kind of helped me see through some of the short-term, wiggles in the market last year, a couple of years. Now, coming into this year, the economy had a fair amount of momentum, which is good, but I think we're now losing that momentum in part because fiscal policy, broadly defined, is turned from essentially a tailwind to a headwind. The Trump administration policies are much more growth negative, in my view, with tariffs being, of course, one big component, but immigration being a big component, healthcare being a big component. Those are all factors that had been either neutral or bullish for the economy and are now net negatives, in my view. Like I say, they'll take a while to kind of have an impact. The U.S. economy, is sort of an aircraft carrier. It takes a long time to turn, but I think it will slow down, and that's going to be a lot of it because of policy changes under Trump.
How would you evaluate last week's jobs numbers? Came in lower than expected. And of course, we had the biggest downward revision in 50 years, I believe. People are talking about this as an indicator for a turning point. Trump fired the BLS chief as a result of last week's revision. But generally speaking, how would you characterize the labor market? Was last week's number an isolated case, or is this the beginning of a longer trend?
Yeah, I think it's consistent with some of the other data we've seen, some of the survey data from ISM and things like that, that shows that employment growth is slowing down. The labor market is not falling apart, but you kind of describe it as a no hire, no fire kind of labor market backdrop. Companies are not laying off large numbers of people. They're not doing a lot of firing, but they're also not doing a lot of, they've really cut back on new hiring. So it's taking longer for people who have lost a job to find a new one, but they're not widespread layoffs at this point. You can also see that in the unemployment claims data that come out each week. There's been a rise in the continuing claims data, the people who are on benefits and staying on benefits, but there's not been a big spike in the new initial claims. So that's kind of been a downshift from solid growth down to sort of very little growth in the employment market. But it reflects both less labor demand, but also less labor supply, which again is tied to that immigration change. There's been a drastic decline in net immigration, and that's reduced the supply of labor. So there are fewer people available to work and fewer people being hired by companies right now.
Here's the thing. We're already in August, so it's pretty much, half the year into Trump's new administration. Changes have been made since day one, policy changes regarding immigration, like you've talked about, as well as policy changes in regards to tariffs and trade. Now, the economy, if it were to fall apart, so to speak, should have done that already, is my argument. And now, 7 months into new policy changes, here we are, and it looks like things are okay for now. So my question is, if it were to take a turn for the worse, why hasn't it happened already? If it continues to drag on like it is, shouldn't the economy just absorb any residual changes that we can expect from the Trump administration?
No, and that's a good question, and certainly one that some of my clients have been asking me about. My response has been, in part, kind of what I mentioned earlier, that it takes a long time for some of these policies to really show up in the economic data and in earnings and things like that. Like I say, it's a very big, diverse economy, and it takes a while to kind of change its direction. Now, I would still point out that when you look at consumer spending, real inflation-adjusted consumer spending in the U.S. For the first half of this year, for the first 6 months of 2025, has been zero. So basically, growth that was pretty solid, kind of 2% growth rate the last couple of years has dropped off to basically zero, which is in that middle chart on the page that you're showing there. And that's been pretty rare when you're not in a recession. It could happen, but it's a pretty sharp drop off from what we've seen all of the years, essentially post-COVID, and it tells me that there has been, in fact, some response to those policies already, showing up in the personal consumption data, which is basically U.S. consumer spending. Now, there's a lot of noise in there still. Some people bought ahead of tariffs earlier in the year, and now they're slowing down. There's been inventory changes. There's been a lot of kind of noise there. But to me, it tells me that consumers are kind of starting to pull back a bit, and that income growth is starting to slow. And that if that continues much longer, I think you're going to see more of the impact coming through in more of the economic data. So GDP growth has slowed down already. Personal consumption has really slowed down. Job growth has slowed down. Prices for durable goods, the things that are most impacted by tariffs, your washing machines and appliances and furniture and things like that, have started to go up. And they were falling for the previous 2 years. So all of those tell me that there are impacts already visible in the data, and they're probably more likely to grow than to recede, given that the tariffs are still there and they're actually getting worse. There are new tariffs coming on, even actually today, and that these things kind of take a while to show up. So it's not surprising that it's taken a little while, but I think there is evidence in the data for some slowdown already relative to where we were the last 2 years. That trend is kind of clearly downshifted and could downshift a little further.
Is the recession narrative still in play? This is the longest, most telegraphed recession that never officially came. Have your clients been still asking you about the prospect of a recession, or has that concept just been given up on?
There was a lot of talk about recession in 2022 and early 2023, and then it really kind of faded. I haven't heard many people talking about it right now. I think most people assume that, kind of as you mentioned, we'll get to sort of maybe slower growth but no recession, going from say 2.5% growth down to maybe something like 1. I think that's a very plausible scenario. I don't think the stock market is priced for that necessarily, but I think that wouldn't necessarily be a disaster. It would just be less than what investors are currently expecting. So I think there's still room for market expectations, investor expectations to kind of account for a potential recession. I don't think we're there yet. Certainly not based on valuations and the way stock prices have been behaving lately. I think a lot of investors are assuming things will be fine and that the policy impacts will be pretty minor, and that the tech and AI and things like that will kind of compensate for all that. I think there may probably more risk to that scenario than the market is pricing in right now.
Well, this is the data for the BEA, as you know, real GDP for Q2. The advanced data was 3%, a huge rebound from Q1's negative number. Incidentally, if you plot the equities markets, like if you take the S&P 500 and overlay this with the GDP chart, there's a rough correlation there. But anyway, what contributed to 3% real GDP growth if not for consumption? We know that consumption was not the reason. Like you pointed out, people weren't spending money.
Yeah, no, you're right, and that's really where you can see a lot of that kind of noise I talked about earlier. That part of what caused the decline in Q1 and the rebound in Q2 was a lot of it was trade. Imports and exports, have drastically moved around in response to all the tariffs and everything else, and so they were a net detraction in Q1 and a net addition in Q2. The same thing is true for inventories, which were a drag in Q1 and a boost in Q2, and then to some degree government spending as well. So a lot of those factors caused that volatility in the headline GDP number, which was much less evident when you just look at consumption alone, what people actually spent. You saw kind of a slowdown over both quarters, net. And so I think there's been a lot of that kind of noise that once you remove some of that, because it'll be up one quarter, down the next, and so you have to kind of average it out over the first 2 quarters of the year. And once you do that, you find that trade overall has slowed down, and that consumption has really slowed down, and that the net effect is that you've got slower growth in the first half than you had, say, in 2024. Once you account for all that sort of ups and downs in the components of it, but it's mostly trade and inventories and to some degree government spending that have caused a lot of that movement in the GDP numbers, and some of that will probably have already washed out.
Well, let's take a look at inflation now and get your inflation outlook. So CPI 12-month percentage change, up 2.7% headline CPI. If you take away food and energy, so if we do just core CPI, that is still high. In fact, it ticked up slightly, 2.8% to 2.9%, I believe, exactly here. So slight tick up as well for core CPI. If you take a look at some individual items, I find this interesting. Electricity spiked up a lot in the last 2 months. Commodities, as we know, it's been booming, and so that may have partly contributed. Food has been trending higher as well, and food away from home. But it looks like a lot of this has come from energy, commodities, electricity, shelter, food. I wonder how much of the 2.9% was actually from tariff-induced higher prices for imports. What do you think?
No, I think there's been a component of that, and like I say, when you look at the prices for the most sort of tariff-sensitive goods, they have started to rise. There's definitely an impact coming through there, but you're right. There's also been an impact from oil price volatility that's showing up there as well, and the cost of kind of rent, housing, is very sort of slow moving and lagged. It got very high after COVID and has been gradually coming back down again. It's still somewhat elevated when you look at the kind of year-over-year changes, but it has been slowing down. Home prices are not rising as much, and housing activity has certainly slowed down. So I think there's going to be a lot more noise in the consumer price data, in part because of tariffs and things like that. And I think there's definitely a chance that you'll see an uptick in the next month or two as well, as some of these prices, again, come through with a slight lag. Companies tried pretty hard initially to prevent tariffs from causing them to raise prices right away. And a lot of them bought, goods ahead of the tariffs to build their inventories so they could sell without raising prices for a little while. But that kind of runs out after a few months. They can only do so much of that. So I think you'll start to see more of those price increases start to kind of filter through into the data over the next, say 2 or 3 months into the CPI and some of the other measures. So I think, again, it's going to be kind of a lagged effect because companies tried to avoid it, but they can only avoid it for so long, and the tariffs are very much still there, and in fact, arguably getting worse for some of them.
Sam, let's talk about Fed policy, and let's get your outlook for what's coming up with the FOMC. So, as you know, no change in the rate cuts in the Fed funds rate in the last meeting. People were talking about speculating a cut by September. I think Powell hinted that may be possible. Can you please maybe elaborate on what you think is going to be possible into the end of the year?
Yeah, that's right. I think until the job market data came out last Friday, it was looking like there probably was not going to be much in the way of cuts. You might have gotten one cut later this year. I think the odds of, say, 2 cuts this year, the rest of this year, have certainly risen. And if we see further slowdown in the labor market data, which the Fed really focuses on a lot, then you'd have the odds of that go up. I think the Fed is really kind of in a bind, which is similar to some of the other central banks, like the Bank of England, where you have the potential to see higher reported inflation, as we just discussed, but also slower growth, particularly in consumer spending and the labor market. And of course, the Fed is supposed to be trying to keep full employment and also low inflation. And right now, they're going to be faced with having those two components of their mandate going in opposite directions. And so they don't want to cut rates if inflation is rising, but they also don't want to keep rates too high if the economy is really slowing. And so they've pretty much said recently that they would have otherwise been cutting rates already this year, except for the uncertainty caused by the tariffs and other policy measures, that they need to wait and see kind of how that's going to impact things. So I think they're going to try to stay on the sidelines as long as they can. They might have to cut in a quarter point in September. I'd be surprised if they did more than that. And maybe again in, say, December if things are looking slower then. But I think they're going to be quite hesitant to do much very aggressively if inflation is closer to 3% than to 2%, which is they really would rather see inflation closer to 2%. And if it's moving the wrong direction, it's going to be very hard for them to justify a lot of rate cuts.
What do you make of Fed Governor Adriana Kugler resigning last Friday? She didn't officially state a reason. She just noted that she's going to return to teaching at Georgetown University. And Trump said that he would appoint an interim governor replacement for her in the coming days.
Yeah, no, it was interesting. And certainly, can't say why, she decided to step down. It may have just been that, the school year is about to start and she wanted to go back to teaching. But also, it does give, Trump certainly an opening to put somebody, at least temporarily, on the Fed board there that aligns with his thinking. And of course, he's been very vocal about trying to pressure the Fed and Jerome Powell in particular to cut rates much more aggressively. And so there's going to be a lot of debate now about how much kind of political interference is going to be on Fed policy, which of course makes it more difficult in some ways for the Fed to cut rates, because then there will be the question in investors' minds, certainly, are they cutting because Trump told them to, or because they really honestly believe that that's the right policy for the economy? And the more of this kind of interference that there is, the bigger that question becomes, and the more questions that investors will have about whether policy is really going to be sort of for the best interest of the economy or just to please the president. So I don't know that this is going to have a big impact right away, but I think as the questions about who's going to be the Fed chair next come up, going into next year, it'll be a much bigger topic in terms of which direction policy is going to look like in 2026.
There's also been 2 dissents from the last FOMC meeting. Both are from governors who are slated to perhaps replace Powell. In other words, they're runners up to replace Powell. I wonder whether or not the equity markets are just pricing in a certainty of lower rates at this point, given so much political pressure. What do you think?
There's certainly that possibility. Yeah, and you're right. That's certainly Waller being in the running for Fed chair, and a Trump appointee himself. Both of them actually were Trump appointees. So there's a reasonable, argument to say that they're listening to Trump and arguing for lower rates because of that, and certainly to maybe curry favor there. They've made the case that they see weakness in the labor market as a reason to maybe cut rates sooner rather than later, which is not maybe shared by some of the rest of the FOMC members. So I think there's going to be more internal debate potentially. You're going to maybe see more dissents than we've seen for quite a while, particularly as we get closer to the end of Powell's term. And then, yeah, I think you're right that who replaces Powell will be a big topic for next year, and the markets may adjust their view on Fed policy, which of course may have an impact on both short-term rates but also long-term bond yields. If people think the Fed will cut rates maybe unnecessarily or too much, and that will cause inflation to be higher than otherwise, that could push the long end of the yield curve, long-term interest rates higher, as people, worry about inflation, growing. So it may have an impact on both the level of short-term rates, but also the yield curve if people start to price in some of that potential, political influence on rates.
Yeah, Waller is slated by prediction markets, specifically by Cauchy, to be the next chairman. Well, his odds have now crossed above 50%. Is he particularly dovish?
I think he has in the past made some arguments for lower rates. I don't know that he's necessarily known as a big dove, but I think that he'll probably be more inclined to listen to what Trump says about lower rates, and probably more biased toward lower rates if he were to become chair. Would be my guess relative to Powell, who seems fine with leaving rates where they are, even though they're still somewhat high in real terms, in order to make sure that inflation doesn't kind of come back, which I think has been more the focus for Powell and the majority of the Fed board so far. I think Waller might shift that a little bit toward either growth risks or thinking about the cost of the Treasury debt and other factors that are not normally part of the Fed's monetary policy considerations.
Let's talk about your outlook for commodities. Starting with precious metals, I believe you've been you've noted in your report that the fact that commodities, base metals, running up a little bit slower than precious metals may be a warning sign for you. Can you elaborate on that?
Sure. Yeah, that's one of the indicators that I used in that model we looked at, and really that's kind of a proxy for global growth, particularly for manufactured goods. That the sort of industrial metals like copper and zinc and aluminum and things that are used to actually create things, whether it's houses or cars or whatever, is kind of a measure of demand, of actual global growth. Whereas precious metals like gold are much more sensitive to investor sentiment, inflation worries, currency worries. Those are much less tied to kind of real economic activity, as well as central bank policy. And of course, part of the reason gold has been going up has been central banks, including China, trying to diversify away from the U.S. dollar, amid concern that sanctions and things like that will become more of a factor for other countries that use the dollar in international transactions. So, to me, it reflects both the concern about, currency and inflation that is pushing gold up, and the fact that China's economy has been struggling. Global growth is likely to be slowing, and particularly for the manufactured goods that are going to be affected by tariffs, that's suppressing demand for those industrial metals that are sensitive to those things, and particularly via China. So, to me, that tells me that we're facing a mixed to weak, global economic growth backdrop, and that has both a combination of kind of sluggish growth and worries about, policy and inflation, particularly relative to the U.S. dollar.
I wonder if that is ample justification for why the Fed kept rates unchanged last time. Take a listen to this particular question. A journalist asked Powell why rates are still restrictive, or policy is still restrictive.
Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with the whole.
Ultimately, Sam, if you were at the Fed today, would you be more concerned with the prospect of higher inflation with the prospect of higher unemployment?
Yeah, I think there probably will be higher inflation. My guess is that if I were on the Fed, my argument would probably be that higher interest rates would not prevent that. They would not limit inflation in that regard. I don't think that interest rates are going to have actually a huge impact either way on inflation or economic growth. I think fiscal policy is much more important than monetary policy. Now, if I were on the Fed FOMC, of course, I'd have to focus on monetary policy, but I would be more inclined to keep rates stable or maybe reduce them somewhat to avoid slowing, economic growth in the labor market more than I would be concerned about inflation caused by tariffs and policy, simply because monetary policy cannot offset those tariff inflation type influences, and those potentially, in theory, could be kind of one-off effects, or at least somewhat temporary effects over the course of, say, 6 months or a year. Once prices go up because of tariffs, they maybe are not going to keep going up, and therefore there might be an argument for looking through them to some degree, meaning just allowing them to happen and not trying to react too much to them because they're not being driven by monetary policy or interest rates. So my inclination would be to focus more on the real economy and labor markets rather than reported inflation in this particular scenario.
And then finishing off on inflation, you wrote that durable goods spending is being hit first. That is where most of the tariff impact is being felt. Durable goods prices normally decline due to productivity and competition, but jumped during COVID before resuming their declining trend in 2023, 2024. Prices have turned back up again this year as tariffs have gone into effect. And so I suppose for the average consumer watching this show, they're probably wondering whether or not to save and buy a TV or a fridge or a used car next year when maybe prices have started to normalize a little bit. Where should they be buying now in anticipation of higher prices even yet to come? What do you think?
Yeah, no, as I said, I think that, kind of what Powell's alluding to and what you see in that chart is that the price increases have started to come through, but I don't think that they're done. So I would be more inclined to maybe, buy the tariffed item that you're considering buying now rather than waiting longer. I think in 6 months, the odds are you're going to be paying a higher price, not a lower one. So I think for those things that are tariffed, anything that has steel and aluminum in it, a lot of appliances, furniture, cars, or at least new cars, those are probably going to be higher in price later rather than lower. So if you have a choice, I would probably do it sooner rather than later. Finally,
this year has been pretty interesting for markets as several new records have been broken. Bitcoin broke new records, gold broke new records, stock markets broke new records. And all this happened while bond yields remained relatively range-bound. And so my question is why? Last time this happened was 2020 when the Fed announced unlimited QE and unleashed money printing that's more or less unprecedented. That did not happen this year. And so, why did all asset classes, regardless of whether or not they were risk on or risk off, reach new highs this year?
Yeah, no, it's been very interesting. And like I say, that's been a very unusual scenario that normally to get certainly an equity market rally like we've seen, you would normally expect to see some sort of big stimulus, monetary and or fiscal. That's what happened in 2020. That's what happened in even back in 1998 when you had the Russian crisis and the Fed cut rates. Most of the big sell-offs in the past that have been reversed quickly were reversed because usually the Fed came and cut rates and maybe bought bonds, and or you had fiscal stimulus, stimulus checks or whatever it might be, or the TARP, back in 2008, 2009. So this has been very unusual in the sense that there has not been any such stimulus this time around. The only thing you really had was kind of, like I say, a less bad scenario for tariffs relative to what was announced in early April. But I think that there was still a lot of money around. I think risk appetite prior to April was still pretty high, and so I think there were a lot of people looking to kind of buy a dip, and then they did. But I think a lot of that kind of fuel potentially maybe now has been used up. So it has been unusual. Rates have not been a driver of the market this year. They were last couple of years. People bought and sold stocks based on what they thought interest rates were doing. This year, that's been much less the case, in part because, bond yields haven't moved much. The Fed has not done anything at all this year with policy rates. So it's been a very stable interest rate environment. I think the gold demand is mostly from overseas and from people worried about inflation. And I think that the equity demand is in part, driven by the tech AI kind of spending, which is, extremely large right now, but coming to some degree at the expense of a lot of other areas of the economy.
Last question before I let you go, your outlook for the best asset class for the remainder of the year. In other words, your most bullish asset class for the rest of 2025.
I think, if you're going to looking at just to the end of the year, I think, large cap U.S. equities are probably still the place to be. I think bonds are probably not going to be very exciting. I don't think they're going to make a lot of money there, but they'll be okay. You'll be safe. And I think overseas markets had been doing well earlier in the year, but I think they're going to struggle against tariffs and the trade war as well. Gold has had a really big run. It could go higher, but I suspect it might consolidate as well now that it's had such a big run. So I think that probably of the major asset classes, it's probably better to stick with large cap U.S. equities, and particularly some of those leading tech names for now, certainly.
Okay, thank you very much, Sam. Where can we go to follow your work?
So certainly you can go to millstreetresearch.com, where you can see some commentary. There's a blog there you can sign up for, and then I post fairly frequently on Blue Sky nowadays. You can follow Mill Street Research there, as well as on LinkedIn. You can follow Mill Street there. And the weekly roundup that you mentioned there, you can subscribe to it on the millstreetresearch.com website.
Okay, we'll put the links down below. So make sure to follow Sam and Mill Street Research there. Thank you again, Sam, for coming back on the show. We'll speak again soon. Take care for now.
Thanks a lot, David. Pleasure.
Thank you for watching. Don't forget to like and subscribe.